If you're still investing like it's 2020, you're already behind. In 2026, money doesn't grow safely anymore. It survives strategically. This video will show beginners exactly how investing works now, where money is moving, and how Americans protect wealth before the next shock hits. Watch closely. One mistake in 2026 costs years.
2026 is not a normal investing year. It's a pressure test. Inflation hasn't disappeared. It's evolved. Interest rates no longer protect savings. AI automation is silently killing job security. And the biggest risk for beginners is believing the old advice still works. The stock market now reacts to algorithms, not emotions. Crypto moves before headlines appear. Real estate no longer guarantees safety. It demands timing and cash flow precision. In 2026, the average American investor isn't losing money because they're careless. They're losing because they're outdated. This is the year where doing nothing becomes the most dangerous financial decision. Beginners must understand one truth early. Investing is no longer about growth first. It's about survival first, then expansion.
Investing is not gambling. It is the intentional placement of money into assets that either produce cash flow, increase in value, or hedge against economic risk. In 2026, every investment falls into one of three categories: income-producing assets, appreciation assets, or protection assets. Beginners fail when they mix these up. Stocks are not savings. Crypto is not income. Gold does not grow fast. Real estate is not passive by default. The smartest investors in 2026 start by defining why they are investing: safety, income, or growth, and then choose assets accordingly. Without this clarity, money leaks silently. Investing only works when strategy comes before emotion.
Stocks remain powerful in 2026, but only for disciplined investors. Passive index investing still works, but volatility is sharper and faster. Beginners should focus on broad market ETFs, dividend-paying stocks, and AI-driven sectors like automation, defense tech, healthcare innovation, and energy infrastructure. Day trading is statistically destructive for beginners. Long-term investing now requires emotional control more than intelligence. Dollar-cost averaging protects beginners from bad timing, while dividend reinvestment builds silent compounding. The danger in 2026 is panic selling. Markets recover, but weak hands don't. Stocks reward patience, not prediction.
Real estate is no longer cheap, but it is still powerful. In 2026, real estate investing is about cash flow, not appreciation dreams. Short-term rentals face regulation. Long-term rentals require strong tenant screening. REITs offer beginners exposure without property headaches. Interest rates punish over-leverage. The winners in real estate are investors who treat property like a business, not a fantasy. Beginners should avoid emotional buying and focus on numbers, location stability, and long-term demand.
Gold and silver do not make you rich. They prevent you from becoming poor. In 2026, hard assets protect against currency devaluation, geopolitical risk, and systemic shocks. Precious metals stabilize portfolios during crises, but underperform during growth phases. Beginners should treat gold as insurance, not a growth engine. A small allocation can reduce fear during market turbulence, and fear management is an investment advantage.
Savings accounts and bonds won't make you wealthy, but they protect liquidity. In 2026, cash is optionality. High-yield savings allow flexibility during crashes. Treasury bonds offer stability during deflationary shocks. Beginners underestimate how powerful liquidity is when markets panic. Having cash when others are forced to sell creates opportunity.
Owning a business is the highest form of investing. In 2026, digital businesses, AI tools, SaaS platforms, and online brands offer scalable income. Investing time, capital, or equity into businesses creates asymmetric upside. Beginners should understand employment income is fragile, ownership income is resilient.
A beginner portfolio in 2026 must be diversified, intentional, and emotion-resistant. Stocks for growth, crypto for asymmetric upside, real estate or REITs for cash flow, gold for protection, cash for flexibility. Allocation matters more than prediction. Survival comes before profit.
The biggest investing mistake in 2026 isn't losing money, it's never starting. Fear will exist either way. Inflation doesn't wait. Technology doesn't pause. Wealth quietly transfers from the unprepared to the disciplined. Beginners who learn now will thank themselves later. Investing isn't about being fearless, it's about being prepared.